Hello and welcome to the Unit 2 of this financial modeling workshop. If you were in class and you're watching this, we're going to change things up just a little bit. It's not going to make any difference to how we went about completing this assignment, but when we were in class, these were already filled out for us, but I'm going to go ahead and show you how we're going to find this forecast data out manually. Oh, it's not going to be provided, so we're going to do that, and I'm going to talk through a couple of different approaches you can take, and we'll go ahead and do that. So thank you if you came to the class, and hopefully this will reinforce some of the ideas and techniques that you learned in the class, and maybe some of it just went over your head, and you can break this down slowly, pause it whenever you want, and figure out what's going on. If you're watching this for the first time and you are not on the email list, so if you're not in the real estate club at UNT, or you're not part of the financial modeling kind of website email list, then what you're going to have to do is I'm going to add a sign up in the comments after I post this, and then what you can do is email me on the website information, and then I will send you this template here, because we're trying to save time here and have a nice template already provided so that you know, it doesn't take so long and it looks nicer. So email me for that, and I will give that to you. Okay, so let's go ahead and get started here, and I'll quickly kind of introduce you to probably the three main ways that we go about finding forecast data. Okay, so it depends on for one, who it is that is performing this analysis. So for this, we're assuming we're analysts for a investment bank, or someone who's looking to buy stock or anything that we're an external individual from the firm and subject. So if this, for example, was Apple, we're going to be investment analysts deciding whether to buy the stock or something along the lines of that. So, but we're not Apple employees or financial individuals that work at Apple. So the most common technique that is used to forecast data is using what's called a top-down approach. And what we're doing is we're just taking an average of the past historical data, and we're kind of making an assumption that what's happened in the past is going to be somewhat of what happens in the future. Okay, so it's pretty easy. You're just taking an average of the data you have historically. The more historical years you have, the better this is, and you can make better judgments of whether this data is useful. So, for example, if throughout, say, a 4 or 5 year period, these growth margins are reasonably stable, then you can be pretty certain that the estimate you use is going to be accurate. But then again, if the data is not stable and it's going up 1 year, down 1 year, and it's going quite volatile, then maybe that is not going to work best for your estimate. So you have to make judgments relative to that. So here we can see 6.5, 7.4 is relatively stable. So it is only 2 years. Now we don't have 2018 because we're assuming maybe this company started in 2019. So we don't have data for 2019 because there is no sales growth. Okay. Same thing for the gross margin here. it's going from 53 to 56, 57, and some of that can be relatively, so even though this isn't the same, it is quite stable. You would hope that over the years, the company is becoming more efficient, and so some of these margins are getting better. So the top-down approach, it's exactly that. And so on the other hand, there's the bottom-up approach. And that would be if we were working in, I think we were talking about Apple, and we could more accurately predict what's going to happen. Because we work there, we have more information. We have a better understanding of how the firm will be in the future. So we can actually forecast exact figures and amounts because we know this. So, but if we're an analyst, we don't really have access to this information, which is why we use the top-down approach. Okay. And then the other thing you can do is use statistical or other mathematical formulas and models to make kind of inferences of what's going to happen in the future. So if we, for example, gross margin is going to be very reliant on the revenue and cost of goods sold. So if we wanted to accurately predict the gross margin, if we got a statistically significant result from those two variables, then we would get a kind of a regression formula to predict that in the future. And so we'll actually go over this in I believe the next unit actually. So we'll get there soon. But for here, we're going to use the top-down approach, and it's the most widely used and it's the easiest. So we're going to go ahead and do that. There's one thing I want to change here at the moment is I don't want this to be a fixed cost. Actually, I want this to be a percent of sales. So I'm going to go ahead and change this to what we have here, the marketing and administrative over revenue. Okay, so we have, oops, what did I do here? So we're going to go back here and divide that by revenue. Okay, and okay, it's not in a percent, that's why. Change that to a percent and we should be good. Okay, and then I'm going to follow that across the years. Good. So for 2022, well, here we're going to just use an average. So it equals average of these. Okay, and then fill that down to there. Okay, and then we're just going to reference these like that. And let's follow that across to 2026. Okay, so we've done that. Done that. So depreciation, depreciation, I have a schedule for predicting that, which I'll go into soon. So we're actually not going to use the top-down approach for that. Okay, and long-term debt over interest. So we've got 6% there, and it's the same. So actually, what I'm going to do here is I'm going to Control C, and across here, what I'm going to do is I'm going to copy this whole thing. Here, I'm going to go Alt ES, and I'm going to copy the formulas. And so it's going to copy all the formulas that were in this, and do the same here and reference these values for it. So we have that, and the tax rate, so here we can see it's 34, 24, 15. So if I take the average, it might not really be very accurate. So what I'm actually going to do is I'm going to say 2022 is probably going to be similar to 2021. Okay, and then for the remainder, let's make it like 20%. Okay, because that's probably somewhere around the middle, and we can go with that. Okay, so fixed asset turnover. Okay, so all of these formulas, don't really need to remember at the top of your head because you can easily look up these online. But what this is the revenue divided by the fixed assets. Fixed assets include, property, plant, and equipment. And so that's actually referencing, okay, actually this is something I want to go over. So you see I've got a reference error down here. What it's not calculating this right is because we don't have a option enabled on Excel here. So I'm going to show you what to do to enable this if you're having this problem right now. So you can go to File, Options, Formulas, and then you're going to enable iterative calculation. Okay. And then it might not still work, and so sometimes you have to press Enter on some of these. Okay. Or you go to data. Sometimes you have to refresh formulas. Okay, let's see what fixed asset turnover. So, okay, we don't have anything referenced up here. That's fine. Okay. So we've got these here. Let's go average of these. Okay. And then we'll copy that across. Okay, so now let's hope this works. So it hasn't quite yet. So that divided by beginning. Okay, so all right. So beginning is here, and required should be that divided by, okay, because we haven't put in revenue. Okay, that's fine. So we'll fill that out later. So let's do the same here as we did up here. So let's just copy this down through here and copy formulas. Okay, that works. Income tax payable. I do the same thing actually. And let's make sure we do the whole cell. Okay, so 7.7, cool. We have everything done. And when we're forecasting, to begin with, we're going to keep debt and equity issuance or payments constant. Okay, so if we don't know how much they're paying down debt, or if they're going to issue more debt or equity, we'd just keep it constant for what it was for the last year. Okay, so now what we need to do is our revenue forecast. So we reference the last period, and we do 1 plus the growth rate, and so that tells us how much we are going to grow our revenue by. Cost of goods sold. Now you can do one of two things here. You can do gross, so we can do revenue by times our gross margin. The gross margin is your gross profit divided by revenue. So if we already have that formula, we can do that. And then we just define cost of goods. So we do revenue minus gross profit. Or what you could do is you could go to cost of goods sold, your revenue times 1 minus gross profit, and that'll give you the percent that's attributed to cost of goods sold. And then you just do revenue minus cost of goods sold, and you'll get gross profit. It does the same thing. So either you pick, you'll get the same answer. Okay, so for everything here is based off of revenue. And so we will do revenue, and I'm going to anchor 33 because I want this to stick to 33 across here, but I don't want it to go downwards. And then I want to multiply that by our assumptions in here. So we start with our distribution. So now I can go down to here, copy these all across. That should work, and just double check that that's referencing the right place. So never assume that everything worked perfectly. Go through and double check. So everything's lining up good there. So we're good. And I have the formula already put it in for here, but all we're doing here to find our EBITDA is taking the gross profit and taking the sum of these out of that, and we get what's left over. Now, depreciation should be down here now, and so something's not quite working yet. And let's see what's going on here. Okay, so this is not working here. So ending should equal depreciation equals that. Sometimes you have to put in that, and I think, okay, so that's what you have to do. So with these iterative calculations, sometimes they get a bit messed up. So what I had to do, I put a 0 in for depreciation. So let's do that for all of them. And so then it kind of runs all of it, and then you can actually make the iterative calculation work and then reference it across. I don't know why it won't just work straight away. And then let's double check that that's working. So the required should equal our ending. Okay, and they do. And what should happen is the beginning plus the additions minus depreciation should equal the ending. Okay, and that works there. So we know that our calculation's working. So to briefly go over what this does is that our required is based off of our fixed asset turnover. And remember, our fixed asset turnover was revenue divided by our fixed assets. So we took the average of what the historic was. And then when we forecast revenue, we can forecast what our required property, plant, and equipment should be. We take what we have in the beginning, and we have that here. And then we have whatever remaining life is left on those assets, and that gives us our depreciation here. So that's easy to find. And then whatever additional property, plant, equipment we need, we have some if statements that run through this. And I'm going to do a course on this schedule here. So if you want to look through it, I would look through what's happening in the model here. And if you're wondering what it's referencing up here, it's a number. So it's a years, but I just don't want that to be seen on the schedule because it looks better like that. Okay, so it's just 1, 2, 3, 4, 5, and that's year 1, 2, 3, 4, 5 of the forecast. Okay, so this is everything to do with capital expenditures and our forecast. And so we can actually do this here as well, our support schedule. The beginning is going to be with the ending of the last period. Our capital expenditures will be our additions. Our depreciation is here. And our ending simply is beginning plus capital expenditures minus depreciation, and that equals this. So we're good there. So you can go ahead and copy that across, and we'll use that later. Okay, perfect. So now we have done that, and so we can go back down to there to reference our depreciation. And our earnings before interest will be our EBITDA minus depreciation. And then our interest is going to be our assumption of what our average interest rate is multiplied by our debt outstanding. So I haven't put this in yet, but this equals up here. Okay, so copy that across. Let's go ahead and do our equity while we're here, just to save us some time. Okay, that's good. And so our interest rate, and that's come through now. And so we can find our earnings before tax by taking our EBIT and less our interest payment. Okay, and then we take our EBIT, earnings before tax, we multiply that by our tax rate assumption, And that is up here. Cool. Now we can figure out our net income. And we also have a dividend payment, which is based off of a 50% payout on net income. And that's just an assumption that we made. Okay, and go ahead and copy those formulas over. Cool. And so we've done our income statement. That's all done. So we can move on to the balance sheet now. Cash, we're going to actually do in our cash flow statement later on. So go ahead and reference the bottom of that, copy that across so that'll fill out automatically. This is our accounts receivable. Accounts receivable is going to be based off of our accounts receivable turnover ratio, our days receivable. And so if you go and look up that formula and then your days receivable, we're going to just work backwards a little bit and use a little bit of algebra, nothing complex. And we're just taking our receivable days here and we divide that by the amount of days in the period. So put some brackets around there. And we multiply that by revenue, because accounts receivable is driven by our revenue. Okay, so the more revenue we have, the more accounts receivable we're probably going to have because we're selling more items. Inventory, on the other hand, is based off of cost of goods sold, because when inventory comes in as raw materials, if it's converted or if the raw materials are just simply the product itself, depending on the industry, the amount of that goes into the product and is sold is going to be in our cost of goods sold, right? So, sometimes we're going to have some left over, or we're going to turn that over with our cost of goods sold. So our inventory assumption is going to be based off of our inventory days. And so we do the same thing, divide that by the days in the period and multiply that by cost of goods sold. Okay, so now we have total current assets, but we don't have cash yet, so we'll do that later. Now we have already done property, plant, and equipment. It's our ending amount here. You can either reference there or reference here. It doesn't matter. They should be exactly the same, and they are. So wherever you do it, it works. Across already. Okay. Now, don't worry about that error message. It's just saying that the balance sheet is not balancing yet, and that's, well, we haven't filled it out all yet. So we'll get there. So go ahead and copy all of that across. So we have that put in. Payables, again, it's similar to the inventory. It's driven by the cost of goods sold. So what you're going to go up to here is our inventory days, not inventory, payable days divided by days in the period, and multiply that by your cost of goods sold. Okay. Well, so you can double check things, like if this went out to like 100,000, you'd know that doesn't look right because it was 11,000. So 11,000 to 12,000, well, that sounds about right because we sold more in 2022, and so our cost of goods sold is more. So of course this number is going to get bigger. So when you're doing these things, when you first create a 3-statement model or any kind of financial model, you're kind of just figuring out things at first, but after you've done them a few times, you'll realize when you make a mistake because you know what you're meant to look for. So keep an eye on things like that if you can, and if you can start identifying that early on, then like good on you, because it took me a while before I got to that point. So income taxes payable, a little bit different here because we base that off of revenue. No, not revenue, our earnings. So earnings before tax, then our taxes. So we get our tax rate. And so obviously our income taxes payable is a proportion of our taxes that we haven't paid. So what our forecast assumption is 37.7%. And so that's going to be based off of our taxes, because that's how much we would assume at the end of the year that we still owe in taxes. Okay. Copy this across now. Copy those formulas. Okay, so go ahead and do the same for these. Cool. Right. We've got all of our debt and liabilities done. So let's do retained earnings. Retained earnings equal the previous year's retained earnings, and we plus our net income, and then we less our dividends that are paid out. We have that. And total equity is the sum of our equity and retained earnings. And our total liabilities and shareholders' equity is all of our current liabilities, our non-current liabilities, and our total equity. Okay, and this, you're still seeing this doesn't balance because we haven't done our cash flow statement yet, which we're about to do. Okay, so the cash flow statement shows how cash actually goes in and out of the company or firm throughout the year. It's different from the income statement because the income statement is not actually a representation of the cash flow of the firm. Okay, because there's non-cash items on it, such as depreciation. When you get into bigger firms, you'll have things like stock-based compensation, and these are items that the firm expenses on their income statement. Therefore, it reduces the tax liability, but they're not things they pay for directly. You're not paying a check. You're not making an actual payment out of your cash account for these expenses. So what we're doing in the cash flow statement is normalizing everything and seeing what actually happened to the cash in the firm. Okay, so the first thing is we're going to go to our net income, and then we're going to start backing out non-cash items. So depreciation, for example. Let's go up to here. That's the only non-cash item we have here. And then we need to make adjustments for the changes in current assets and current liabilities, because the full expense of these items are in our income statement, but these changes represent what actually occurs in terms of the cash items of this. So, if our receivables or current asset increases, we've actually got a negative cash flow to adjust for, right? Because when we account for our revenue, we account for every sale that happened in whatever set period. But if some of those items are receivables, we've accounted for everything, but we haven't received cash on all of those items, right? So we need to back out the changes. So if it increased, then that's going to reduce our net income that we accounted for. Sorry, not net income, our full revenue. And then we're going to see actually how much cash did we receive from our revenue. So the change is going to be our the period ending the year before less the next period, because what that's going to do is if it's increased, this is going to be a negative number. If it decreased, it's going to be a positive number. Okay, and so that's how we do that. We do the same thing for any current asset. We do this. An increase will cause a decrease, and a decrease will cause an increase to cash. Okay, so inventory. Cool. Okay, and it's the complete opposite for current liabilities, because current liabilities is something we have to pay for. So if something we've paid for has increased, then we haven't actually incurred that cash item yet. So we're going to adjust for that. So it's the opposite. The next period, and I've written something wrong at the next period minus the last period, because that'll show an increase as a positive number. Do the same thing for income taxes payable. You know, we have everything for our operating activities. And Control C, Alt ES, so let's copy formulas. Okay. You can copy this whole thing across now because everything's filled out, so it should be working. And it is. There we go. So investing activities, we only have capital expenditures here. And that's our additions. Well, but we actually did this on here, so we can reference there. Okay, so make sure we have negative on there because capital expenditure is something we're going to have to pay for, and we need to represent that as a negative cash flow. And copy that across to financing. So remember I said we weren't issuing any more. We weren't issuing any more equity, and we weren't issuing any more debt. Now we did pay dividends, so put a negative there and go up to our income statement. And I'm just seeing that I haven't filled across retained earnings, so make sure you do that. Okay, so now we have that done. Copy that across. Okay, so what's our increase and decrease of cash? Well, it's the summation of these three cash flow items here. Okay, so we increased, and our beginning is going to be our ending of the last year, and then our ending will be these two added together. And we see this is said okay now because it's gone ahead and balanced. And remember, back at the start of the balance sheet, I told you to reference the bottom here. So now we have a value in there. And it should do the same for all of them. And it did. So when these all go green, say, okay, well, everything's balanced. And that's the great thing about this three-statement model is you know if you've done it right or wrong because it should balance. And if it doesn't balance, then usually you can go and figure out where you've gone wrong. For a model like this, it's relatively simple. There's not too many items. When you get into larger items, it can be a little bit more complex to find out where the error it went. So it's important to be careful early on. So now you can see we've got a nice three-statement model. We've got our assumptions in here. We've got our income statement done, balance sheet completed, cash flow statement completed. We have our additional supporting schedules. We've got our capital expenditure and depreciation forecast. We can fill out this here. It's just additional information. So retained earnings, net income. And this is just to get you, I added this to get you to understand what's going on so you can reference items if you want to look back at this. So dividends, we're up here. And it's that plus that minus that. That across. And debt at the beginning was that we didn't make any changes. So you could go up to here, and then it's just going to be that plus that. And this is copy that across. It's just taking calculating your interest. We already did that. So just taking the average of the beginning and ending, because we might not know when we're actually making our payments. So we can make an assumption that taking the average of the beginning and ending will give us the most accurate answer there. And we would multiply that by our average interest item here. So actually it should be here. Okay, so that doesn't change anything. So I just added this to fill out, it filled out automatically for you, and I made some charts. And if you want to go see how these charts are made, or you can kind of go to see what type of chart it is. This is a combo chart, and you can see where the information is coming from here. It's all coming from up here. And I made a dashboard here, which is kind of some of this here, just over here, and you can see what's happening. So here we can look and see that both revenue and gross profit are increasing through the years quite consistently. Same as EBITDA and EBIT, and pretty much the same for everything in here that's to do with earnings. So back to here, now a three-statement model is very, very useful when you're trying to value a firm, and then you want to do a, like say, a discounted cash flow model, or you want to do comparisons to other firms in the industry. We can use their information here to move forward and build upon this to create more information. If you hit 1 here, it closes everything nice like this. It will close the charts as well. But once you open this back up again, they will display like that. Cool. So that is the first part of Unit 2 for our three-statement model, and we did build a whole three-statement model there. I guess I didn't add earlier that this historical information would always kind of be provided to you, or you would have sourced this from a reputable source. You know, like this is a public company, you could get this from their 10Ks. If you have Capital IQ or Bloomberg, you can get this historical information from there. And then I think you might have to have a premium membership now, I think, for Yahoo Finance to get this stuff. But there's a lot of different places you can get this historical information to do things like this. Or if this is a private company, like I do, sometimes, well, not all of the time, you'll be provided this by their accountants or the owners, etc. So I hope that was useful. And if you have any questions, please leave comments and reach out to me. Again, if you would like the template for this, I will put the details to the websites to reach out to me too. And then I can send that along to you once you contact me. Okay. So thank you for watching, and I appreciate it. And we will carry on with further models later on. I look forward to sharing those with you.